match the global value of every economic transaction that happens everywhere, every day, in a year. And it takes a few weeks.
Obviously, all of us trade currency fairly regularly. If you go abroad, you exchange into another currency. That's a form of currency trading. You're swapping your pounds into whatever, euros or yen or whatever it might be. That happens fairly regularly, and that's a conventional part of the trading process. Now, large corporations have to do this on a regular basis. Where it becomes something that people question, and where you get people saying, well, hang on, this is speculation, is when you get people realising that currencies move around next to each other. And if they move around in value next to each other, there's always an opportunity to try and make money out of those changes in value, and therefore you can speculate on it. And that's the more sort of questionable end of the market. That's the bit of the market that things like a financial transactions tax would try and chop away at. Because the assumption there, and it's kind of not incorrect, is that this just produces instability for everyone else. That these people want volatility in the market because that's how they make their money. They want to encourage it, and they do encourage it by trading and speculating in the way that they do.
By 2010, the foreign exchange market had grown to be the largest and most liquid market in the world, with an average of $4 trillion of currency being exchanged every day.
Volatility creates a need. What does it do to countries, especially perhaps small ones like developing countries, if there are suddenly huge and instantly fluctuating financial flows? What do they have to do to cope?
Production of the products that they're selling on the
Increase their production and sell more,
lowering the price of it,
lowering the price,
and becoming possibly even poorer.
Once you start talking about the international system, it becomes really quite a peculiar thing, in that a lot of it depends on simply sentiment and beliefs about what an economy is like, rather more than it depends on anything the economy might or might not actually be doing. And that can shift very, very rapidly, because if it's just somebody's belief about a currency is supportable, then they can carry on believing this until whenever. If that belief changes, and can change very rapidly in a financial market, the process of financial contagion can take place in just minutes, seconds even, that you can just move from being apparently quite a stable, robust economy to being one that suddenly sentiment has turned against you, and you find that markets are picking on you. And it can often be not much more than you're simply a next door neighbour of a country that's currently in trouble.
Many of the world's financial crises in the past 30 years have been caused by rapid withdrawals of the nation's currency or the currencies of an entire region. This type of activity is often referred to as financial warfare.
It's benefited major institutions really quite substantially. Goldman Sachs, for example, or any large bank, has done somewhat better out of this set of arrangements than it would have done in a far more regulated environment. It's made people very, very wealthy. It's allowed financial markets to expand absolutely enormously. Anybody involved in that is keen on seeing a deregulated world. In the case of the UK, you have a government which has been quite overtly and deliberately and aggressively arguing against any forms of regulation being imposed on those financial markets. But it's not the case that someone's behind the scenes pulling the strings. It's that this is how the thing works quite deliberately, quite overtly in front of you. That's the world as it is. It's making some people very rich. They're quite happy with it.
I think it is a form of economic warfare. Much of the change in the way that the global economy works over the last 30 years result from this debt, this third world debt, because it's given rich countries and banks and the financial sector enormous amounts of power and control over the poorer bits of the world where a lot of the resources are that we like using. And that's been used in a way that many people have compared to a form of colonialism. I mean, it's a very real, direct form of power that's been used over those countries to force those countries to do what are really in the interests of the richest segments of the world that they do. And as a result of that, not only have corporations become absolutely, made huge amounts of profits and become absolutely enormous and all pervasive, but the financial sector has become even bigger than that. And the real money in the world to be made today is not by producing anything at all. It's simply by forms of speculating, basically making money from money. That's the most profitable and by far and away the biggest form of activity, of economic activity that exists in the world today.
To protect themselves, vulnerable countries need to accrue currency from rich countries, who create these currencies out of nothing.
The Netherlands' first Governor General of Indonesia, the man who built the trade routes, fortified them. What I mean by that is built forts along them and fought Spanish fleets and British fleets, said about the development of the Netherlands Empire and Netherlands trade was, "We cannot make trade without war, nor war without trade." Money and power. So reserves have become the way in which you can insure yourself against what? Speculation. You said speculation. Speculative attack. Fall in the market. Bubbles.
When a country succumbs to a speculative attack, it is asked to deregulate its markets and conform its financial system to that of the dominant party.
The big problem that's faced by most developing countries who got into a debt crisis was that they were told by the powers that be in the world, the International Monetary Fund, which is in many ways governs the global financial system, that the way to get out of debt actually is first of all to restructure your economy, especially to increase your exports so you're earning more dollars, and then you can pay off your debt, which is normally in dollars or some other foreign currency. Unfortunately, time and time again that was proved to not be the case at all. Actually, countries cut back their public spending to the bone, so they stopped growing, they stopped having any potential for growth, and what they did produce was aimed at the export market, was aimed at creating dollars and so on. So they were paying off their debts, but they weren't developing their own economy at all. They were paying far more in debt repayments than they were spending on health or education or anything else, and their debts just kept getting bigger and bigger and bigger.
The country becomes a vassal state, allowing large corporations to exploit its natural resources and workforce.
It's not even shadowy. There's no great mystery about what's happening here and about the way the world operates. It's quite blunt. I mean, for the last 30 years, you've got something pretty much everywhere, well, it certainly spreads pretty much everywhere, that generally gets labelled neoliberalism, this idea that you should have floating exchange rates, weak regulation, particularly of financial markets, minimal government interference or involvement with what market does, and that's more or less how the world operates. And then there are institutions, and the outstanding one at this point is the IMF, that will actively try and enforce this state of affairs. So it's not greatly shadowy, if you see what I mean, that there are people behind the scenes somewhere trying to manipulate stuff. It's actually, this is quite overt. This is happening, and this is how, for my entire adult life, actually, is what it starts to look like. This is how the world is operated, and it's made some people very, very wealthy. It's produced enormous concentrations of wealth.
So when the International Monetary Fund comes in order to try and alleviate a country's debt problems, it imposes a set of conditions. And in the 1980s and 90s, they called that set of conditions structural adjustment program. And it tends to take very similar forms wherever it happens. And indeed, we can see structural adjustment programs in essence happening today in countries like Greece and Portugal and Ireland, where countries are instructed to decrease the amount that they spend on the public sector. They are instructed to liberalise their trade market and liberalise their capital market, so money can much more easily come in and out of their economy. And the idea is that this will encourage investment to come in from richer parts of the world, and that all of their problems will be solved from this investment. And in actual fact, this has proved time and time again to be completely without foundation. In actual fact, what happens is it destroys fledgling industries and capacities in these developing countries, and developing countries become completely dependent on goods and services from developed countries and also from capital from developed countries. One of the things the International Monetary Fund is very keen on is telling countries to lower the taxes that should be paid by multinational corporations when they come and operate in a country, because then you'll encourage more multinational corporations to come in. Of course, what it also means is the profits that are made by those multinational corporations leave the country just as quickly, and the country itself doesn't benefit. And today you have many developing countries which have got almost no tax base. They've not developed a tax base at all, and so they're even more dependent on international capital markets, on the money markets, on creating debt. And that's why you have so many countries in the world that have really been robbed of their sovereignty. It's very difficult to see how democratic societies can evolve or function when actually a government is more dependent on the diktats of the International Monetary Fund and the money markets than it is on their own people.
What we've seen since the 1970s is a dramatic increase in a series of phenomena that have had a stimulative effect on the changes in the financial system that have brought us to the gleaming, shining metal and steel business that's over there. In case you don't know, that's the City of London I'm pointing at.
To compensate for the lack of a defined, commodity-based value underlying currencies, financial institutions developed securitization as a means to manage risk.
You develop securitization as a means to try and stabilize the whole system. This is a set of financial processes and financial innovations that really accelerate from the 70s, 80s onwards.
You had a chaotic system that needed to manage risk, and you had to innovate. You needed derivatives, options, futures. You have new markets in volatility management tools. Who knows what the term hedging is? Spreading your risk, managing your risk, insuring against your risk, precisely.
Up until very recently, up until the 1960s, the Securities and Exchange Commission would be quite clear that derivatives that weren't based on real products, like agricultural products, so pork belly futures or whatever, would in fact be essentially kind of gambling, and therefore you weren't allowed to trade them. That changes in the 60s, and everybody can trade, currency futures, things that are not based on real products being traded at some point in the future, but are based on movements of currency prices. Once you have the system of fixed exchange rates breaks down, obviously this thing accelerates enormously. So as you get the rollback of government regulation here, you get the market taking over with its own products here. And the theory is that the market's better at regulating itself, it's more stable than if you have the government interfering all the time. The efficient markets hypothesis, the idea that you set up a financial market, they're fast, everybody in them is well informed, they all keep a very careful eye on what everyone else is doing, it'll therefore be very stable and it'll reflect real changes in the economy. It's not going to be driven by panics and manias and speculative bubbles. None of this really going to happen. If there is movement up and down, it's because something real is happening and traders and investors in the financial market are responding to it. So that's the efficient markets hypothesis. The practice, and I think what you see in 2008 is the kind of end of that process. The appearance of a crisis so major, the belief that it will simply be self-stabilising and self-regulating really can't carry on. I mean, the practice carries on anyway, but you can't really argue in the same way that you used to that it's good or it's necessary or this is okay for the world.
In the last decade, we had a new innovation, something called the credit default swap, a way of buying insurance against the company you've invested in going bust. And in 2002, they were worth in total less than $1 trillion. In 2007, they were worth $60 trillion. That's 5 years.
Everybody's suddenly sitting there and thinking, oh, these CDOs we've made don't in fact provide the kind of stability that we thought. The maths that's inside of them is complete nonsense, it turns out. There's far more risk attached to trying to securitize risk and securitize debt in the way that we have done this than we thought, and we think these things are now worthless. The attempt to get more and more complex ways of regulating and shaping a financial market and trying to make a quick buck out of it as well actually helped produce the opposite effect to what its kind of apologists said, which is that it led to a spectacular crash.
What we saw as a result of this very different situation was one phenomenon above all, one sector above all grew, and that was the financial sector.
While the financial sector benefits enormously from the current monetary system, the system is neither stable nor fair.
The assumption in what the Bank of England does right now is that the cash that we hold is backed up by government debt. The government can back up its promises by the fact that it can tax the public. So what they're implying is that cash is backed up by government debt,